Welcome back to the ComLucro channel. In this video, we break down smart money concepts and show how professional traders use market structure and liquidity to execute high-quality scalping trades. We will cover key ideas such as market direction, liquidity, imbalances, optimal trading zones, and entry confirmation. Then walk you through 3 high-probability scalping setups using smart money concepts. To wrap up, we will review real chart examples to show how these scalping strategies are applied in live market conditions. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. We will begin with the first trading model. This strategy is built around 3 core components. These are a draw on liquidity, a liquidity grab, and the entry itself. For this setup, 2 time frames are used to execute the trade. On the higher time frame, key liquidity levels are identified and a clear draw on liquidity is defined. From there, we move down to the lower time frame. At that level, the goal is to spot a liquidity grab that aligns with the direction of the draw on liquidity. Once that occurs, the trade is executed, and both the target and stop loss are set accordingly. Before moving to the charts, it is important to note that this trading plan is not restricted to a single time frame. That said, the entry time frame should always be 2 time frames lower than the higher time frame. Based on your trading style, there are 3 time frame combinations you can apply. As an example, when using the 4-hour chart as your higher time frame, the 15-minute chart should be used for trade execution. Now, I will walk you through how this looks directly on the price chart. The first step is to identify a draw on liquidity on the higher time frame. But what does a draw on liquidity actually mean? In simple terms, it refers to recognizing a key liquidity level that price is actively moving toward. More often than not, the market is drawn to areas where liquidity is resting, such as equal highs, equal lows, or strong reversal points, because these zones contain a concentration of stop losses and pending orders waiting to be executed. These liquidity levels should always be marked manually on the chart. In this tutorial, the focus is on reading raw price action and applying smart money concepts without the use of indicators. By marking these areas yourself, you gain a clearer understanding of how liquidity forms and how price behaves around it. The next step is to zoom into a lower time frame and look for a liquidity grab that aligns with the direction of the draw on liquidity. With that in mind, let us move down to the lower time frame. Keep in mind that buy-side liquidity is positioned above current price. With that context, the objective now is to see a swing low taken out. In other words, we are looking for a bullish liquidity grab, which suggests a potential continuation to the upside. On the chart, this type of liquidity grab is identified directly through price behavior. A bearish liquidity grab occurs when price trades above a previous high but quickly falls back inside the range. This shows that buyers failed to hold higher prices, and that price was immediately rejected, pointing to bearish momentum. After this kind of move, a stronger push to the downside is often expected. In contrast, a bullish liquidity grab forms when price trades below a previous low and then rapidly returns back inside the range. This indicates that sellers were unable to sustain lower prices and that the market rejected that downside move, signaling bullish momentum. Once a bullish liquidity grab has been identified, the trade can be entered as soon as price returns inside the range. A more conservative option is to wait for price to continue moving higher to confirm the reversal, and then look for fair value gap formations to place a buy limit. If no clear fair value gaps are visible on the 5-minute chart, dropping down to the 1-minute chart can provide additional precision. Now, let us begin with a brief recap of the bearish setup. In a bearish scenario, the first task is to identify a key liquidity area that price is moving toward. This may be a previous low or a level where a large number of stop losses are clustered. These zones tend to draw price in before a reversal takes place. Once that area is defined, move down to the 5-minute chart. At this stage, wait for price to push above a recent swing high and then quickly return back down. This behavior indicates that liquidity has been taken and that the market may be preparing to move lower. After this confirmation, enter a short position and place your stop loss above the high created by the liquidity grab. Allow enough room for price to fluctuate and avoid placing the stop too tight. For your target, focus on the next clear sell-side liquidity level. This approach keeps the trade structured and intentional. Now, let us move on to the second trading setup. For this setup, 2 time frames are used to execute the trade. The 1-hour chart serves as the higher time frame, while the 5-minute chart is used as the lower time frame. On the 1-hour chart, the focus is on analyzing market structure to determine the overall trend. Look for breaks of structure and changes in character to define directional bias. Now, let me walk you through how this looks on the price chart. The first step is to determine market direction by identifying structural breaks and potential reversal signals. This is done by reading price action directly on the chart. By marking breaks of structure and changes in character, we can clearly define the prevailing trend. In this case, price is breaking structure to the upside on the 1-hour chart. That tells us the market is in an uptrend, so our focus remains strictly on buying opportunities. The next area of interest is fair value gaps. These gaps represent price imbalances, where the market moved too quickly and left inefficient pricing behind. Over time, price often revisits these areas as it seeks balance. We treat these gaps as key zones of interest, where reactions are likely to occur. The process is simple. First, wait for price to return into the fair value gap. Then look for confirmation on the lower time frames before executing a buy trade. At this point, we switch down to the 5-minute chart. On the lower time frame, the final step is to watch for signs of a potential reversal. One of the strongest clues is the appearance of a bullish liquidity grab pattern. This behavior shows that sellers were unable to push price lower, pointing to growing bullish momentum. If the next move also produces a change of character, that adds an extra layer of confirmation to the setup. With those conditions in place, the trade can be executed. The stop loss is placed below the low created by the liquidity grab, while the target is set at the next significant level on the higher time frame. The same logic applies in a bearish scenario. Begin on the higher time frame by identifying the overall trend. In this case, price is forming lower lows and lower highs, which confirms a downtrend, meaning only sell opportunities are considered. From there, fair value gaps are marked as potential supply zones. When price retraces into one of these areas, drop down to the lower time frame and wait for a bearish liquidity grab to form above a recent high. After confirmation, enter the trade. The stop loss goes above the liquidity grab, and the target is aimed at the next key level below. With all of this in mind, proper risk management is essential to protect your capital. Follow your trading plan and avoid emotional decision-making. Be patient, wait for high-quality setups, and never risk more than 2 to 3% of your account on a single trade. Now, let us move on to the final trading strategy. The third trading strategy also relies on 2 time frames and brings together the concepts of buy-side and sell-side liquidity sweeps, and fair value gaps as the entry framework. So, what do buy-side and sell-side liquidity actually mean? Liquidity sitting above a high or a series of highs is considered buy-side liquidity, while liquidity resting below a low or a group of lows is defined as sell-side liquidity. What typically happens around these areas? Institutional participants, often referred to as smart money, actively target these liquidity zones. For instance, when smart money intends to build long positions, a large number of sellers is required to fill those buy orders. That raises an important question. Where are those sellers located? When price approaches a key support level, many retail traders and sometimes institutions enter long positions. Their stop losses, which function as sell orders, are usually placed below that support area. To access that liquidity, smart money drives price lower to trigger those stop losses and collect sell-side liquidity. This process provides the necessary selling pressure to fill large buy positions. At the same time, the break below support often attracts additional sellers who believe price is about to continue lower. In many situations, once that liquidity has been taken, price quickly reverses and moves higher. This reaction traps both early buyers and traders who sold the breakout. The same principle applies in the opposite direction with buy-side liquidity. When smart money is looking to sell, buyers are needed. To achieve this, price is pushed above a key resistance level, triggering buy-stop orders and breakout entries, before reversing lower after sufficient liquidity has been gathered. With that in mind, not all liquidity levels carry the same importance. Certain conditions make some levels more reliable than others. Liquidity formed around major swing highs and lows, higher time frame levels, or areas where multiple equal highs or equal lows are present tends to be significantly stronger. Now, let me show you how the third trading strategy plays out on the chart. To begin, mark the buy-side and sell-side liquidity zones directly on the chart. After that, wait for price to move beyond one of these areas, and then quickly close back inside the range. This behavior represents a liquidity sweep or false breakout, where smart money has already collected orders and is likely positioning for a move in the opposite direction. From there, drop down to the lower time frame and identify fair value gaps that formed immediately after the sweep. These gaps highlight price imbalance and can be used as potential entry zones. In a bearish scenario, for example, after price sweeps above a buy-side liquidity level, look for a fair value gap along with signs of reversal. Once confirmation appears, a short trade can be taken. The stop loss is placed above the high of the sweep, while the target is set at the next key level or sell-side liquidity below. The same logic applies in a bullish scenario. In this case, the focus is on sell-side liquidity resting below key lows. When price sweeps that level and closes back inside the range, it signals a bullish liquidity grab. Next, move down to the lower time frame and wait for a bullish fair value gap that forms immediately after the sweep. This gap serves as the entry zone. Enter a long position from the gap, place the stop loss below the swing low, and target the next buy-side liquidity level. This straightforward process allows you to trade alongside smart money rather than against it. Keep in mind that taking more trades does not automatically lead to higher profits. Developing the patience to wait for high-probability setups and filter out low-quality opportunities is a skill that requires both time and discipline. Before we wrap this up, it is important to connect everything we have covered so far with a broader and more practical framework. Understanding liquidity and reading market structure correctly begins with knowing where price is operating and where liquidity is actively forming. These concepts do not work in isolation. Together, they reveal market intent and help traders anticipate future moves with greater clarity. To reinforce this, we are going to play a short clip taken from the full video shown in the card, titled How Professional Traders Use Liquidity: 4 Advanced Trading Hacks. This clip is meant to give you a preview of the framework and encourage you to watch the complete breakdown, where each hack is explained in detail. Let us begin. Hack number 1 is to define the trading range before doing any other analysis. The starting point is straightforward. Before looking at anything else, you must first determine the current trading range. So what exactly is a trading range? It is not simply a box or a period of consolidation. A trading range represents the area where price is actively moving and where liquidity is forming. In simple terms, this zone provides the clearest insight into where price is likely to move next once it breaks above or below it. And while price remains inside this range, close attention to price action is essential. So how do you properly identify the current trading range? The first step is to zoom out to at least 1 or 2 higher time frames compared to your execution time frame. For example, if you enter trades on the 1-minute chart, your range should be defined on the 15-minute chart. If you trade on the 5-minute chart, look to the 15-minute, 30-minute, or 1-hour charts. If your execution time frame is the 1 hour, then your trading range should be taken from the 4-hour or the daily chart. This is a crucial rule. Never define your trading range using the same time frame you use for entries. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.